really great being here at Disrupt Miami with all of you guys. Met a lot of the faces at our booth, and really excited to be presenting JKL Group here at this stage for you. We came to this conference with the slogan Fund to Farm, which actually covers our two major business lines, as well as briefly speaks about where we come from and where we are headed next. Today we will be speaking about how institutional investors see crypto mining business, but also I will be introducing a little bit our business lines. Fund part of the slogan is represented by JKL Capital, based in Hong Kong. We have an asset manager offering quantitative trading strategies, directional arbitrage strategies, holding 300 million AUM at the moment. We also have an OTC desk under the umbrella of JKL Capital. We have a venture capital fund and a lending platform. The farm part, more importantly, is represented by JKL Mining. So recently, we have launched a 35 megawatts facility in Midlands, Texas, and we have everything set in place to expand up to 85 megawatts by the end of this year. Let's have a little introduction and visit our farm. So, for the main keynote topic, discussing how institutional investors see crypto mining, we have actually come up with a framework of 4 main points you have to highlight next time you speak to an institutional investor. The framework is summarized in GRID, where G stands for green, R stands for return on investment, I stands for investment in the underlying, and then D is for the discounted cash flow model. Let's go into more details for each of the 4 points. Point number 1, Bitcoin has a great case to act as a load balancer. 1, it's stable, continuous demand for energy. 2, can be switched off. Bitcoin mining can be switched on and off at any time. And 3, it's location agnostic, meaning that there is no wastage of energy due to transportation. Combine this with the fact that just in the second quarter of 2022, Bitcoin mining has reached 60% of sustainable energy mix. And the fact that 46% increase in mining efficiency is the year-on-year figure, all these factors make a great case of Bitcoin becoming an ESG-grade product. Now, imagine the immense pool of institutional investor capital that flows into the space the moment Bitcoin mining specifically becomes ESG graded. The green bonds, the green energy ETFs, all of that is institutional capital which is waiting to be deployed in the mining industry. The second point is return on investment. This one is actually quite interesting because Bitcoin mining has linear return on investments, meaning that regardless of whether you put upfront 10,000, 100,000, 1 million, 10 million USD for miners, you will still make your money back in around 2 years on average. This is very unconventional for traditional businesses, which require a much higher capex initially and also have a very flat ROI, return on investments, in the first years of the project. The third point, the I, is represented by investment in the underlying or exposure to the underlying Bitcoin. Even investors who do not want to expose themselves to the underlying crypto because it's too volatile end up having a very safe cash-generating wealth management asset on the one hand, which is the mining, and they do get to enjoy the beta of the mined Bitcoin. Now it's up to them what they want to do with the mined Bitcoin. If they don't have any risk appetite at all, they can cash out, buy T-bills, they can hodl the Bitcoin, or they can go for quantitative strategies like the ones that we offer at JKL Capital. We have our arbitrage strategy and directional strategy. The beauty of quantitative strategies is that they are built to maximize risk-adjusted returns specifically. Based on the risk-adjusted returns profile, quant strategies are generally a much better idea than any traditional investment that is usually made for benchmarking. The fourth point, to encompass the fourth point, let's look into what some legendary traditional investments say about investing in general. The most popular quote across all investors is, for example, one said by Peter Lynch, who is a legendary investment of Magellan Fund within Fidelity Investments. Never invest in any idea you can't illustrate with a crayon. If you look across many other investors, there's same quotes there, all saying you should never invest in something you do not understand. The problem institutional investors see with cryptocurrencies, there is no standardized valuation model that you can apply to each cryptocurrency to derive the present value. Plus, there is the volatility aspect. For mining industry, it's quite different. Regardless of whether you own miners or mining farms, you have your projected future cash flows, which are key to the DCF model. DCF, for those of you who are not into finance, is the basic of all the M&A, all the valuation activity out there. If you own your mining facilities, you have your projected future hosting fees. If you own miners, you have your projected future mine BTC. You just discount it down to present value, and you get a very simple traditional valuation. And that is your crayon drawing just there. So to sum up the discussion, once again, the framework is grid, 4 points, easy to remember. There are much more points out there. If you're thinking of any of them, please come over to our booth, number 239. We're just at the entrance. We're happy to discuss anything on the capital side, on the mining side, about the weather, parties tonight. Really happy to make new friends. Great to be here, and enjoy the rest of your conference. Thank you.